Hi, welcome to another video talking about expat taxes. I'm Alex McGowin, owner of McGowin Tax LLC, where we specialize in doing tax consulting and compliance for small businesses and individuals with international activity, international assets, anything cross-border basically. So today what we're going to be talking about is totalization agreements. This is a question I get a lot and something I see a lot in practice, specifically in the expat world. And there's different aspects to the totalization agreement, but today what we're going to be talking about is how it affects self-employed people, self-employed U.S. citizens who move to a foreign country and are subject to potentially double social taxes, and how does that totalization agreement impact them. So let's jump in. So totalization agreements for self-employed people in particular. So this is the typical client situation that I see and what we're going to talk about today. We have a U.S. citizen who has a sole proprietorship in the U.S. and they do some sort of consulting business, make money, make income. So they're living in the U.S., have a sole proprietorship. That income flows through their personal tax return. They pay U.S. income tax, federal income tax, and federal self-employment tax. Self-employment tax is what self-employed people it's Social Security and Medicare tax for self-employed income. So generally, if you're an employed person in the U.S., you get a Form W-2. The U.S. employer does your payroll. They pay your Social Security and Medicare taxes for you. They pay half of it, and then half of it comes out of your paycheck, whether you know that or not. When you're self-employed, there is no withholding, so you have to pay that, and that is what the self-employment tax is. You get a 1/2 deduction for it, so that there's parity between self-employed people and employed people, and you pay the full amount with your tax return after that deduction. So in our scenario, we have this U.S. individual with a self-employed business living in the U.S. They move to Spain. They become a tax resident of Spain. They're going to pay income taxes to Spain, and they're going to pay the social taxes of Spain as well. So we're going to talk about how this totalization agreement comes into play. So what do we know in this scenario? U.S. person moving to Spain, self-employed. If you've watched any of my videos or you're an expat yourself, you know the U.S. has citizenship-based taxation. So that means from an income tax perspective, they still have to file a U.S. tax return and pay U.S. income taxes on their worldwide income. They're also paying taxes to Spain, income taxes to Spain. So what we do in the U.S. is there's a foreign tax credit or a foreign earned income exclusion that alleviates that double taxation that we run into from an income tax perspective. So we can take care of that. The problem is the self-employment tax. So the self-employment tax, you cannot offset that with a foreign tax credit or a foreign earned income exclusion. So let's say you make $50,000 self-employed income. You can exclude all of it under the foreign earned income exclusion from income tax. So you have no tax, no income tax. That gets added back for self-employment tax purposes. So you're going to pay self-employment tax, which could be as high as 12 to 15% self-employment tax on that $50,000. But in our scenario, you're probably also, and we're going to assume you are in this case, paying social taxes to Spain. So that's a clear double tax, and there's no foreign tax credit available from a self-employment perspective. So what do we do in that scenario? That's where the totalization agreement comes into play. And what I missed here is the actual name of the Spanish version of Social Security tax is RITA, or the Régimen Especial. I'm not going to try to say that. I'll mess it up. But if you're a tax resident of Spain earning self-employed income, you have to pay into their system, which is their equivalent to the Social Security system. So that's the double tax that we're looking at. So that's where the totalization agreement comes in. So broadly, what the totalization agreement does is it's an international agreement. It's not a tax treaty. It's its own separate thing, an agreement between the Social Security systems of the two countries. And it serves to prevent dual Social Security taxation and help to coordinate the benefits between the two countries. So, basically the two things that it does is it assigns the right to tax that person from a social perspective to one country or the other, so that there's no double tax. And then it also allows you to use benefits or credits earned from one country for purposes of applying for Social Security in the other country. That's not what we're talking about here today, but it does have that other effect of, if you need 40 quarters of work in the U.S., but you left for Spain after you'd only worked for 30 quarters in the U.S., you can potentially use this totalization agreement to use the work credits that you earned while you were abroad for purposes of applying for your U.S. Social Security benefits. But today we're talking about the double tax effect. But one thing to point out is there's only 31 countries that the U.S. has this totalization agreement with. Some important ones that are not included, basically all of Latin America, except for Brazil and Chile. And Mexico, there's been a drafted one for years, but it's never actually been ratified. And then New Zealand as well does not have a totalization agreement. So look out in those countries, because we'll talk about this more in a second, but if you're in one of these countries and you have the situation that I just mentioned where you're paying self-employment tax in the U.S. and in, say, New Zealand, there's really nothing you can do in that structure, at least. So what we have to do is look for different structures to make it more tax efficient. But the totalization agreement is not available. So how do we actually use this totalization agreement? So when you open it up, and I left a link in the site here, but it's on the Social Security website where they give you a link to the actual document. It's not that long. It's pretty easy read, actually, but they have most of them, maybe all of them, have a table of contents, and there'll be a self-employed workers section. And so basically what you have to do is, if you're a U.S. person working in Spain and you want to be exempt from U.S. Social Security taxes because you're covered under the Spanish Social Security system as a resident there, you have to tell the IRS that you're covered in Spain. So you do that by getting a certificate of coverage from the Spanish government. And this, the agreement itself tells you what you need to do. So in this page, it's telling you what you need to include in that letter. And then on a different page, it tells you where you send the letter. So basically, you prepare a letter to the Social Security system of Spain, send it in, and they'll send you back what's called a certificate of coverage. You take that certificate of coverage, attach it to your tax return, exempt yourself from self-employment tax in the U.S., and then you're done. So that's basically, in a perfect world, the process that you go through. So just to summarize it again, you apply for the certificate of coverage, you get it back from the foreign government, you attach it to your tax return, exempt from self-employment tax, and then you're done. A lot of times what we see in practice, though, is that, maybe it's April 14th or let's say October 14th, and you didn't know that your client had self-employment income for that year. So they don't have this certificate of coverage, and they're not going to get it before the tax return due date. So one thing you can do, and what I do a lot, is you can still exempt them based on their being covered under this, being eligible for the certificate of coverage, basically. And I attach a statement in the tax return to show that they're eligible for it, and then I will advise my clients to, in the meantime or concurrently, to go ahead and apply for that certificate of coverage so that if there is a question from the IRS later, you have that document that you can show them. And in my experience, at least, that has worked for clients that have been asked later to prove their certificate of coverage. Even if they got it after filing the tax return, they can still use that as evidence of being covered. And so I just want to show also just how this is done procedurally. So I personally use CCH Access, and the way you do this in the system is there is in the worksheet view, there's actually a tab for the self-employment tax, and you go in and you check the box here that says covered under the SE system in another country. So it doesn't say the word totalization. That threw me off for a little while. But just remember, when you fill out the Schedule C section, you're not going to show it as not self-employment income. I see that sometimes where people mark it's not self-employment income so that it doesn't print to the self-employment tax page. That's technically not correct, and it can cause problems where you have a self-employment person, maybe they receive 1099s or 1099Ks, and so you might have a matching issue with the IRS. It's still self-employment income, but it's covered under the self-employment system of another country. So you check that box, and And two things are going to happen. On Schedule 2, at least in CCH Access or a different version of CCH, I think it works the same. It prints a statement on Schedule 2 where it shows that it's exempt and it references an attached statement. And then in the footnotes, you have to manually do this footnote, and you're going to mention the specific totalization agreement that it's under. I just printed United Kingdom one here. I know we're talking about Spain, but you would change that in this example for Spain and show the effective date. So that's it. I hope this is helpful. I hope that helps you understand how the totalization agreements work for self-employment people. Again, there's all different aspects of the totalization agreement, how it applies to employed people, how it applies to corporations that employ people, and elections you can make to choose which side you're going to pay the self-employment tax to. But this is probably the most common one from an expat standpoint. So I hope this helps. Talk to you next time.